Have you ever taken a trade, watched it play out, and then after it was over, looked at the chart and thought, why did I even take that? Or maybe the setup was actually right. Price went in the direction you expected. The level worked. The idea made sense. But you still didn't make any money because you entered too early, exited too soon, moved your stop, or got scared out before the real move happened. That's the part of trading that nobody talks about. Because a lot of traders don't lose because they don't know enough. They lose because they don't know how they behave when money is on the line. And that's why today we're talking about journaling. Not just tracking wins and losses, your screenshots, your rule breaks, and the patterns that keep showing up again and again. Because your strategy might not be the problem, your execution might be. Now, before we get started, this video is for educational purposes only. I am not a financial advisor, and you should definitely trade at your own risk. Now, if you've been following this channel, you know I've been breaking down technical analysis, indicators, market structure, Fibonacci, VWAP, supply and demand, and different ways to read the chart. And all of that matters. But at some point, you can know the chart and keep making the same mistakes. You know where support and resistance is. You can know the trend. You know VWAP. You can understand liquidity. You can wait for confirmation. But then once you're actually in the trade, everything changes. That's where execution comes in. Because one thing I noticed after reviewing my own trades, the system wasn't always the problem. Sometimes the setup was fine. The problem was me not executing it in the way I said I would. Entering early, taking profit too fast, holding a loser too long, moving a stop, trying to make money back, taking a trade that almost fit the plan, but didn't really fit the plan. And once I started seeing those patterns clearly, I realized something. Most traders just don't need another strategy. They need a better way to review their execution. So in this video, we're going to talk about why journaling matters, different ways you can journal, what you should actually track, and how a behavioral journal like ExecutionIQ can help you find the places where your trading breaks down. Not just your P&L, your behavior, your decisions, your execution. A lot of traders get stuck in the same loop. They lose a few trades and immediately think, maybe this strategy doesn't work. So what do? They search for a new strategy, they add another indicator, they switch time frames, they change markets, they watch another video, they rebuild their chart, they start over again. Sound familiar? And don't get me wrong, sometimes your strategy does need work. But a lot of times, the strategy is not the first thing that needs fixing. The execution is. Because be honest with yourself. How many times have you ever had a plan before a trade, but once you got in, you didn't follow it? You said you were going to wait for confirmation, but you entered early. You said your stop was going below structure, but when price got close, you moved it. You said you were going to let the trade breathe, but you closed as soon as you saw a little profit. You said you were done after 2 losses, but you took one more trade because you wanted to make it back. You said you were only taking clean setups, but boredom pulled you into something random. This is not always a strategy problem. This is an execution problem. And the dangerous part is, if you don't track it, you'll keep blaming the wrong thing. You'll think the setup failed, when really, you didn't follow the setup. You'll think the market was against you, when really, you were trading from frustration. You'll think you need a new strategy, when really, you need to study your own behavior. That's why journaling is so important. A trading journal is just not a place to write down entry, exit, and profit or loss. That's the basic version. A real trading journal is like a mirror. It shows you what you actually did, not what you think you did. Because after a trade is over, your memory can lie to you. When you win, you might ignore the mistakes because the trade made money. When you lose, you might become too hard on yourself and miss what you actually did right. And when you're emotional, you might rewrite the whole story in your head. You might say, I had a good reason for entering. But when you look back in the screenshots, there was no confirmation. You might say, I had to exit because price looked weak. But when you review it later, you realize you exited because you were scared to give back profit. You might say, the market just trapped me. But then your journal shows you chased directly into resistance. That's what journaling does. It separates the story from the facts. It forces you to stop asking only, did I win or did I lose? And start asking, did I follow my plan? Was this actually my setup? Was I calm when I entered? Was I trying to make money back? Did I respect my stop? Did I exit based off of logic or emotion? Did I trade my rules or did I trade my feelings? Those are the questions that actually help you improve. Because the goal is not to just make money on one trade. The goal is to become the kind of trader who can repeat good decisions consistently. Now, there are different ways you can journal, and I don't want you to think there's only one perfect way to do it. The best journal is the one that you'll actually use. Some traders like a simple notebook, and honestly, that can work. You can write down the setup, why you entered, why you exited, what you felt, and what you learned. The benefit of a notebook is that it slows you down. Sometimes writing by hand makes you process the trade differently, but the downside is it can be hard to organize, hard to search through, and hard to spot patterns over time. Then you have spreadsheets. A lot of traders use Excel or Google Sheets. With a spreadsheet, you can track win rate, average win, average loss, risk to reward, setup type, time of day, and whether you followed your rules. Spreadsheets are good because they give you data. You might start to notice things like, I lose more after I take 2 losses. My best trades happen when I wait for a pullback. I keep forcing trades when the market is choppy. My reversal trades are killing my account, but my continuation trades are actually working. This type of information is valuable, but the downside is spreadsheets can feel cold. They may show the numbers, but they don't always show the full context of the trade. Then you have screenshot journaling. This is one of the most powerful ways to journal because trading is visual. A screenshot shows what the chart looked like when you made the decision. And that matters because later you can go back and see, was there a clear setup? Was price at a key level? Was there confirmation? Was the market trending or ranging? Did you enter in a good area? Did you chase? Did you exit at a logical place? Or did you panic? A screenshot keeps you honest because sometimes the truth is right there on the chart. Then you have emotional journaling. This is where you track what you were feeling before, during, and after the trade. Were you calm? Were you frustrated? Were you rushing? Were you trying to make back a loss? Were you afraid of missing out? Were you trading because the setup was valid or because you wanted action? This matters because the same setup taken from a calm mindset and the same setup taken from desperation are not really the same trade. The chart may look similar, but the trader behind the decision is different, and that difference can change everything. Then you have rule-based journaling. This is where you track whether you actually followed your trading plan. Did the setup meet the rules? Did you enter where you planned? Did you respect your stop? Did you take profit according to your plan? Did you stop trading when you were supposed to stop? Did you avoid low-quality trades? This is where journaling starts becoming more than record keeping. It becomes execution training because now you're not only tracking the trade, you're tracking whether you actually behaved like the trader you said you wanted to be. And this is exactly why I built ExecutionIQ. I want to be transparent about that from the start. ExecutionIQ is my product, but I didn't create it because I thought traders need another basic journal that only tracks entry, exit, ticker, and profit or loss. I built it because I keep seeing the same problem. A lot of traders are not struggling just finding setups. They're struggling with following through with setups they already know. They're struggling with execution. They're struggling with emotions. They're struggling with reviewing their trades in a way that actually shows them what went wrong. Because most of the time, P&L only tells you the result. It tells you whether you made or lost money, but it does not always tell you why. It doesn't tell you if you entered early. It doesn't tell you if you moved your stop. It doesn't tell you if you exited because the setup was invalid or because you got nervous. It doesn't tell you if you took the trade because it met your rules or because you were frustrated from the last one. That's the gap that ExecutionIQ is built to help solve. It's a behavioral trading journal. That means the focus is not just on the trade. With ExecutionIQ, you can upload your trade screenshots, write why you exited, track what you were feeling during the trade, and review whether you actually followed your rules. And that's because sometimes you don't notice the pattern until it's right in front of you. You might look back and realize, every time you marked yourself as frustrated, your trade quality dropped. Every time you entered before confirmation, the trade had a lower chance of working. Every time you traded after a loss, you were more likely to break your rules. Every time you exited early, it wasn't because the setup failed. It was because you were scared to give back profit. That's the kind of information that most traders are missing. Because P&L only tells you what happened. Execution review helps you understand why it happened. And that's the difference. So when I show ExecutionIQ in this video, I'm not showing it like it's a magic fix. It's not going to place the trades for you. It's not going to make you disciplined overnight. And it's not going to replace having a real trading plan. But what it can do is give you a clearer way to review your screenshots, your decisions, your emotions, and your rule following. So you can start seeing the execution leaks that keep costing you money. This is where Execution IQ makes the review process easier. Instead of writing down whether the trade won or lost, I can actually look at the full picture. I can see a screenshot from the trade, why I entered, why I exited, what I was feeling at the time, whether I followed my rules, and what lesson came from the trade. That matters because I'm not guessing. I'm not trying to remember what happened after the emotion already passed. I have evidence right in front of me. And when you start reviewing your trades like that, you can begin to see patterns that are costing you money. Now, whether you use Execution IQ, a notebook, a spreadsheet, or a screenshot folder, here are things I think every trader should track. First, track the setup. What was actually the reason for the trade? Was it a break and a retest? Was it a supply and demand reaction? Was it a VWAP bounce? Was it a liquidity grab? Was it a Fibonacci pullback? Was it a trend continuation? Was it a reversal attempt? Because you might think you trade one way, but your journal may show something completely different. You might think you're patient, but your journal might show you take random trades when the market gets slow. You might think you only trade the best setups, but your journal might show you keep forcing low quality trades after a loss. You might think your strategy is the problem, but your journal might show you're not giving the strategy a fair chance because you keep breaking your rules. That's why tracking the setup matters. Second, track the market condition. Was the market trending? Was it ranging? Was it choppy? Was price near a major level? Was volume supporting the move? Was there a clear higher time frame basis? This matters because some setups work better in certain environments. A trend strategy can get chopped up in range. A reversal strategy can get crushed in a strong trend. A breakout setup can fail over and over again if the market does not have enough momentum behind it. So when you track the market condition, you start learning when your strategy actually performs the best. You stop treating every setup like it has the same probability, because it doesn't. Context matters. Third, track your entry quality. Did you enter where you planned, or did you chase? Did you wait for confirmation, or did you jump in because you were afraid of missing the move? This is huge because a lot of traders have decent trade ideas, but bad entries. They might be right about direction, but wrong on timing. And when your timing is bad, even a good idea can turn into a stressful trade. You enter too high on a long, you enter too low on a short. Price pulls back normally, but because your entry was bad, now you're under pressure. Now you're questioning the trade. Now you're tempted to move your stop. Now you're reacting emotionally to something that could have been avoided with a better entry. That's why entry quality needs to be tracked. Fourth, track your exit. Why did you get out? Did price hit your target? Did price invalidate the setup? Did you trail your stop? Did you take profit at structure? Or did you exit because you got nervous? This is where a lot of traders find their biggest weakness. Some traders cut winners too early. Some hold losers too long. Some move stops. Some take profit too fast after a losing streak because they just want to feel good again. Some hesitate to take profit when the market is clearly showing weakness. If you don't track your exits, you won't know what's really happening. You'll just keep saying, I need to hold winners longer, but your journal might show something more specific. Maybe you only cut winners early after you've already taken a loss. Maybe you cut winners early when price gets close to prior high or low. Maybe you exit early when the trade pauses, even if structure never broke. This is useful information because once you know the exact pattern, you can work on the exact problem. Fifth, track your emotional state. Before the trade, ask yourself, am I calm? Am I confident? Am I frustrated? Am I bored? Am I rushing? Am I trying to make money back? This is one of the most underrated parts of journaling because emotions are not always bad, but untracked emotions are dangerous. If frustration keeps showing up before your worst trades, you need to know that. If boredom keeps showing up before your random trades, you need to know that. If fear keeps showing up before your early exits, you need to know that. If overconfidence keeps showing up before you size up too much, you need to know that too. Because the same setup taken from a calm mindset and the same setup taken from desperation are not the same trade. The chart may look similar, but the trader behind the decision is different, and that difference can change everything. 6. Track whether you followed your rules. This might be the most important question in the whole journal. Not did I win, but did I follow my rules? Because a winning trade, whether you broke every rule, can reinforce bad behavior. And a losing trade, whether you followed your plan, can still be a good trade. That's hard for newer traders to accept because most people judge trades by money. But serious traders judge trades by execution. Did you do what you said you were going to do? That's the standard. Because if you cannot trust yourself to follow your rules, then even a good strategy becomes inconsistent. Once you start journaling consistently, you'll begin to notice patterns, and some of them may be uncomfortable. You might realize you don't lose because of one big mistake. You lose because of the same small mistake repeated over and over. Maybe you always take your worst trades after a loss. Maybe you enter too early when price gets close to your level, but not actually at your level. Maybe you trade better at the beginning of the session and give money back later. Maybe you're profitable on continuation trades, but terrible at reversals. Maybe you're good at finding direction, but bad at holding the trade. Maybe you keep exiting winners early because you're afraid the market is going to take the money back. Maybe you keep moving your stop because deep down, you don't want to accept the trade idea was wrong. That's the kind of stuff a journal reveals. And once you see the pattern, you can start fixing it because you can't correct what you refuse to track. And that's why I like thinking about a journal as a feedback loop. You take the trade, you record what happened, you review your behavior, you find the pattern. Then you make one adjustment, not 20 adjustments. One, maybe this week your only goal is no trades after 2 losses, or no entries before confirmation, or no moving the stop once the trade is live, or no exiting unless structure actually changes, or no trades unless the setup checks every box. That's how you improve, not by randomly changing everything, but by identifying one execution leak and working on it until it gets better. Because if you try to fix everything at once, you'll probably fix nothing. But if you focus on one pattern at a time, now you have something clear to work on. And that's the clarity that most traders are missing. And I want to be real with you here. A lot of traders, myself included, have had moments where the chart wasn't the biggest problem. It was the reaction to the chart. You know the setup, you can see the level, you can understand what price should do. But when you're in the trade and real money is moving up and down, fear starts talking, frustration starts talking, greed starts talking. That voice that says, move the stop just a little bit. That voice that says, take the profit now before it disappears. That voice that says, you need to make back what you lost. That voice that says, this one's definitely going to work. And the scary part is, in the moment, it can feel logical. You convince yourself that moving the stop makes sense. You convince yourself that taking the trade early is okay because you see what's about to happen. You convince yourself that exiting early is smart because you're protecting profit. But then later, when the emotion is gone, you look back and realize the trade was never really the problem. The decision making was. And if you don't have a way to review those moments, they just disappear into memory. The next day comes and you do the same thing over again. That's why journaling's not just about keeping records. It's about building self-awareness. It's about catching the version of you that shows up under pressure. Because that is the trader you need to study. Not the calm version of you watching a replay. Not the relaxed version of you drawing levels after the market closed. The real trader is the version of you making decisions while the candles are moving. The money is changing and your emotions are trying to take control. That's the version you have to understand. So here's a simple journaling framework you can start using right away. After every trade, answer these questions. Number 1, what was the setup? Number 2, why did I enter? Number 3, where was my stop and why? Number 4, where was my target and why? Number 5, what was I feeling before I entered? Number 6, why did I exit? Number 7, did I follow my rules? Number 8, what is the lesson from this trade? That's it. You don't have to write a whole essay. You don't have to make journaling complicated. You just need enough information to see the truth. Because if you write down what you wish happened instead of what actually happened, the journal can't help you. The power is honesty, even when it's ugly, especially when it's ugly, because those are usually the trades that teach you the most. And here's another thing, don't only journal the big losses, journal the small mistakes too, because a lot of bad trading habits don't start as account killers. They start as little expectations. I'll move my stop just this once. I'll enter early just this once. I'll take one more trade just this once. I'll ignore my rules just this once. But if you keep making the same exception, it's not an exception anymore. It's a habit. And if that habit is costing you money, you need to see it clearly. That's what the journal is for. Now here's something a lot of traders miss. Journaling the trade is step 1. Reviewing the journal is where the growth happens. Because if you write everything down and never go back and study it, you're just collecting information. At the end of the week, go back through your trades. Look for patterns. Ask yourself, what setup performed best? What setup performed worse? What mistakes showed up more than once? Did I follow my rules? Did I trade better when I was calm? Did I force trades after a loss? Did I cut winners too early? Did I hold losers too long? Did I trade during bad market conditions? Did I take trades that actually matched my plan? Did I make money because I traded well? Or did I get rewarded for bad behavior? And don't only review your losses, review your winners too. Because sometimes your winning trades hide bad habits. You might have made money, but still took a bad entry. You might have won, but risked too much. You might have broken your rules and got rewarded. And that can be dangerous because the market can reward bad behavior in the short term. But eventually, that same behavior catches up to you. That's why your review should not only be about the result, it should be about the quality of your decisions. So when you review your journal, don't just ask, how much did I make? Ask, what did my execution look like? Did I follow my process? Did I manage risk? Did I stay patient? Did I wait for confirmation? Did I respect my invalidation point? Did I trade like the person I said I was going to be before the market opened? That's a much better question, because if your execution is improving, you're moving in the direction even before the P fully reflects it. This is why journaling is one of the most underrated skills in trading, because another indicator might help you see the chart differently, but a journal helps you see yourself differently. And once you start seeing yourself clearly, trading changes. You stop chasing every setup. You stop pretending every loss was random. You stop blaming the market for mistakes that you can actually fix. You stop jumping from strategy to strategy, because now you can see whether the issue is really the system or your execution. And I'm not saying indicators don't matter. I'm not saying your strategy doesn't matter. You still need a real trading plan. You still need rules. You still need risk management. You still need to understand market structure, context, and timing. But if you keep breaking your rules, no indicator is going to save you. If you keep revenge trading, no setup is going to save you. If you keep moving your stops, no strategy is going to save you. If you keep cutting your winners because you're scared, no perfect entry model is going to fix that by itself. That's why execution matters so much. Because the best strategy in the world means nothing if you can't follow it when it matters. That's when you start making real progress. Not because every trade becomes perfect, but because you finally have feedback. You finally have evidence. You finally have something real to study instead of relying on memory, frustration, or how the trade felt in the moment. And that's what a lot of traders are missing. Not more information, better feedback. So if this video hit home, here's the main thing I want you to remember. Your strategy might not be the problem. And if you're not journaling your trades, your screenshots, your emotions, your entries, your exits, and your rule following, then you may be repeating the same mistakes without realizing it. Start simple. Take screenshots. Write down why you entered. Write down why you exited. Track how you felt. Track whether you followed your rules. And review it at the end of the week. Because once you can see your patterns, you can start changing them. And if you want a better way to do that, check out ExecutionIQ. Like I said earlier, ExecutionIQ is my product, and I built it specifically for traders who want to understand where their execution breaks down. It's a behavioral trading journal that helps you review your screenshots, your decisions, your emotions, and your rule following, not just your P&L. It can also grade your trades and give you an AI review. So you're not just logging what happened, you're getting feedback on your execution. P&L tells you the result, but your journal tells you the reason. The link is in the description below. And before you go, drop a comment. What's your biggest execution mistake right now? Do you cut winners too early? Hold losers too long? Enter too soon? Move your stop? I want to hear it, because once you name the pattern, you can start working on it. Make sure you like the video and subscribe to the channel, and I'll see you in the next one. This is XViper TV. Thanks for watching and happy trading.